Hello and welcome to Thrive Talk. We focus on shifting businesses from surviving to thriving, and my guest today is deeply entrenched in that process. He's a biomedical engineer, an electrical engineer, and a wonderful guy. Welcome Daniel Goldberg, the co-founder of Bridgement.
Thanks, man. Really good to be here today.
You know, I always feel like after an introduction like that, I should dub it with like an applause in the after. So if you hear one, that's what it was. It's good to have you on the show. I've been looking forward to this conversation.
Thanks, man. No, it's good to be here.
So, biomedical engineer, before I go into the Bridgement side of things, I'm fascinated by your background. So biomedical engineer, electrical engineer, experience in banking, all of that stuff, that's part of your history?
Yeah, absolutely. I ended up going into biomedical engineering because as a teenager I was interested in medicine, but I wasn't interested in being a doctor.
Okay.
So I thought, how can I have a bigger impact and impact more people's lives? And so I started to look into some of the science and the engineering behind medicine. And I discovered this amazing degree called biomedical engineering.
Yeah.
It was a fairly new degree at Wits University at the time, and decided to go down that route. So I studied biomedical engineering. It's essentially a hybrid of electrical engineering and medicine.
Okay.
And then went on, did electrical engineering, loved software, loved data science, loved all of that. But ended up going into banking because I was also interested in entrepreneurship, and in management consulting, and after university ended up going into management consulting at one of the American firms, and they put me in their division that consulted to banks and other financial service providers in South Africa and in Nigeria, and it was off the back of that I got my first sort of dip into the banking and finance world.
Sure. What an interesting history.
Yeah.
I dig that.
Yeah.
On biomedical, it sounds like you're in there with a coat and a thing of big glasses and that nothing blows up in your face.
Yeah.
That's what I'm picturing, a lab coat.
Yeah, so there are actually lots of different verticals or specialties within biomedical engineering. They often divide them into what they call the wet and the dry side of engineering.
Okay.
So we were very much on the dry side. What that means is, so on the wet side, that would be more like your genetic engineering and dealing with maybe pharmaceuticals and things like that. On the dry side, you're looking much more at like the medical imaging machines, your MRI and your CAT scans, and how those machines work and how the imaging works and how your ECG and your EEG machines and all these various electronics devices work and how they play in the medical field. So so that obviously involves a lot of software, a lot of hardware, a lot of data science and machine learning in terms of extracting images and optimizing those images that doctors can see and pick up issues in a better way, applying the right filters, etc. So I was like way more interested in that side of things, and so I focused most of my electives and all of that on that stuff. Yeah.
Brilliant. And today you sell money.
Yeah, it was, I loved engineering so much, but I also was always interested in business and in entrepreneurship. In university, I even tried to start a business while studying. Didn't go down so well, but learned a lot of lessons and really enjoyed the process. Yeah.
Cool. And then, so we arrive at Bridgement. Now, Bridgement is co-founded by you and?
So I had a partner in the early days. He's no longer with the business, but he was a CTO in the business in the early days. Yeah. So came up with the idea towards the end of 2016, and it was off the back of my experience in the consulting space. So consulting to some of the banks and seeing firsthand how inefficiently some of the banks were operating, and also seeing how often SMEs were sort of lost in the middle of consumer banking and corporate banking.
Yes.
I saw firsthand how often they were overlooked or underserved. And so it was off the back of that, and then it was also off the back of my involvement in another business and having first-hand experience in how difficult it was to raise funding, whether it was equity or debt, and manage cash flow and manage late-paying clients. It was off the back of all of that I thought, hey, there's definitely a need for an easier way to get funding as a business in South Africa. I saw a lot of innovation that was happening overseas. Of course, a lot of the time that innovation might work overseas, doesn't necessarily
Yeah, it doesn't translate
to South Africa. But I spent a lot of time looking at the South African market, seeing what innovation had happened here, what gaps were still existed in the market.
Yeah.
And off the back of that, decided to start Bridgement, at least the first version of Bridgement.
Sure.
At the end of 2016. Yeah.
Okay. And that first version, what did it look like?
So initially, one of the biggest gaps that I saw in the market was a simpler way for businesses to get invoice finance.
Okay.
I found that there were a lot of traditional invoice factoring and discounting companies. A lot of the banks had their own products.
Yeah.
And there were some other non-bank providers as well, but it was very difficult to actually access. And a lot of the time, most SMEs were not large enough, or they didn't have large enough debtors books or invoices, or their clients weren't blue chip enough, and they couldn't get access to that finance.
Okay.
So it was off the back of that I thought, okay, how do I make this more accessible to more SMEs? And to do it on smaller invoices, and to obviously, use my experience in engineering and data science to offer the sort of simplest, best, most automated way. I obviously came across what was happening in the cloud accounting space, where you had new cloud accounting software providers like Xero really disrupting the market. Sure. And essentially what they were doing was creating a core accounting platform with a completely open model where they could have a marketplace of apps and partners that could integrate with their APIs and easily access the data that Xero was housing for their SME clients, and enabled a whole host or wave of fintechs to create new apps. Not only fintechs, I mean, lots of different types of apps within that Xero ecosystem. So I saw that and I said, hey, that's an amazing way to offer invoice finance, because what I can do is enable a business to just connect their Xero account. I can get all of their invoices automatically into our platform. We can have a dashboard. Our platform can automatically vet those invoices and see which ones they can receive funding on or get an advance payment on. So that was version 1 of Bridgement. It was a digital invoice finance product only for Xero customers.
Love it.
Yeah.
I love it. And that Xero ecosystem, I've said it 1 million times, and I'm sure 1 million people will say it another 1 million times. It's just such an incredibly powerful place to do business. And as we said before, even if you only did business there, there's enough business to be done.
Yeah, absolutely. I mean, we've in those days, it was very early days for Xero in South Africa.
Sure.
I think they'd been around for a few years, and really only on the ground for maybe like a year or two or whatever it was before then. So it was quite early days. They still had a significant customer base, apparently. I mean, the official numbers are never released, but from what you hear in the market, it seemed like they were gaining a lot of traction. And I thought it was a great place to start. Obviously, since then, we expanded our product offering and the different types of businesses we support and cater for. But it was a good place to start, or a good, as people like to call it, a good beachhead to land on.
That's great.
And penetrate the market. Yeah.
Nice. And luckily you did, because it's a great success story since. I mean, one of the things that I love about what you guys are doing now is sort of in that billboard space. I don't know if you guys did it first or Pineapple, but one of you did it. And I love to see that the marketing is out there, and it justifies the spend for smaller business. I'm saying before blue chips and everybody's sticking up billboards and spending big money, it's nice to see South African brands really taking advantage on that sort of medium size and really getting a win.
Yeah, absolutely. I think just to clarify, Pineapple was definitely before us, as well as Naked and all those guys. I would never, ever claim to be on the same level as them or before them. In fact, I think we took a lot of inspiration from them.
Sure, I think a lot of people did, actually.
I don't think we've been nearly as edgy and out there as them.
Sure.
But huge inspiration. It's really cool to see what they've been able to do, and it's quite interesting to see fintechs and tech companies just in general go
getting
full
in that
circle
space.
from digital acquisition back to outdoor media, Babylon type marketing. It was a big unknown for us initially. but it was a super interesting channel for us, at least, to work on, to try and build up some brand equity and awareness.
Sure. And is it working?
I believe it is.
Okay.
It's always, when you're dealing with outdoor media and above the line type stuff, it's quite difficult to do attribution.
Yeah, I was going to say attribution will be hard, but if you're seeing the general trend and the discussion there, is anybody saying, "Hey, I saw your billboard"?
Yeah, absolutely. So, we employ a whole bunch of tactics to try and, do attribution in a better way. It's very difficult when you're not on a digital channel.
Sure.
And I can say that it definitely is working. It's, it's somewhat anecdotal. We believe we've done some data analysis to show that it works. But it's also always difficult to isolate it, to consider it in isolation, because we're doing so many other things. You know, we've got radio, we've got a bunch of PR and event stuff, we've got a bunch of digital marketing channels, various channels. So they all play into each other.
Absolutely.
So it's been an interesting learning, and we still continue to learn and test and see how things work.
Yeah, that's excellent. And from us, we all here with you. So please keep pushing it. We love it. So let's talk about the lending side. One of the words I've used to describe what you guys do is an alternate lender. Alternate, obviously, to the traditional side of the banks. What's your description? I know you had a slightly more fancy description.
So we often do refer to ourselves as an alternative credit provider, but I think we also refer to ourselves as a fintech credit provider to SMEs, and that's always important to me, at least, because there are many non-bank credit providers, both in the consumer world as well as in the SME world, that have been around for a really long time. I think what really makes us different is the fintech aspect. And ultimately what that means for our clients is that they will get much better experience, much quicker turnaround times online, no need for paperwork and meeting in person and things like that. And that's all largely enabled by that fintech piece.
Yes.
I think we've been recognized for that quite a bit. Last year we were announced as the Xero app of the year for South Africa, which was a huge recognition to come from a multinational corporate like Xero. Really meant a lot for us. And I think, we still, to my knowledge, I believe we're still the only SME credit provider in South Africa that is integrated into all of the 3 top cloud accounting packages. So Xero, Sage, QuickBooks Online, we're the only one, which still blows my mind, because it's not, it's complicated, but it's not rocket science.
I think you're underselling how difficult it is. Nagging Panda does it. I'm saying we're obviously integrated for different reasons. You're giving the money, we're trying to go get it. But I think the difficulty in integrating and managing all of that is it actually takes a real effort, and to keep it functional at all times is a whole new ballgame.
Yeah, absolutely. It's definitely not a once-off. It's something, there's a lot of maintenance, and those APIs that you're integrated with change over time, and they're breaking changes, and there's definitely a lot of complexity. But it still does surprise me that a bank with their budgets in the whatever it is, hundreds of millions of rands, have still not gone down this route. We've seen so much value, and found that it's such a great way to make the life of an SME or business owner so much easier, and make it much easier to access funding. Just taking a few steps back, that's one of the many ways in which we leverage fintech. We leverage tech in offering finance to offer a better product and a better experience.
Which is excellent. And part of that better experience, and you touched on it briefly now, is the speed. And I'm fascinated by the speed of these things, because I think even one of your billboards said something about you can't break the speed limit while you're driving, but we can in granting you a loan. There's a risk to giving anybody money. I've been involved in debtors books for a long time, and it's easy to give things away, whether it's a mobile phone or a product or whatever it is you're giving away. If you're giving away money, not difficult. But giving it to the right person who's going to pay you back and is reliable is actually quite a difficult thing to do, to vet correctly. Doing it at such speed, at some point, does it become a riskier business because you're trying to give the customer their service faster? Are you pushing the boundaries of clever decision making? How do you manage that?
I think it's a good question. I think really what enables us to have such quick turnaround times is that tech piece that I mentioned. So we've built a huge amount of automation around this, a very high degree of the decision making that happens in the background is fully automated. Assessments are fully automated. And so what that enables our team to do is to only ever spend time on outlier information. So if anything unusual is picked up, or some sort of outlier is picked up, they can focus on that and work out what's going on, and that's quite difficult to automate away. That being said, I think those outliers and exceptions we reduce them over time. As our system learns and sees what normal is, we're able to reduce a lot of those outliers. And so the degree of automation is just getting better and better and better. Will we get to a point where everything is just 100% decided? Is it possible? Yes, I would say it is probably possible. Is it going to happen in the short term? Probably not.
I don't think so.
We have to be realistic. I think
you also got to be careful. You're running a business.
100%. I think in the consumer world, it's a lot more. It's possible and a lot more achievable in the short term. And I think many people have already achieved it in that world. But what you find when you're dealing with businesses is that things are a lot more complicated. A business, an individual, or a consumer, they tend to look very similar from one to the next in terms of how they live, what their average, how they spend their money. Obviously, there's variability, but what they spend the money on,
the basket of goods is quite
exactly. It's
quite
a
similar.
lot more limited. There's a lot less variability, or some might say it's a lot more homogeneous, homogeneous, if I pronounce it correctly. But and typically a majority of consumers will be taking salary once a month, or might be a weekly wage. But there's a lot more standardization there.
Yes.
In the business world, when you're dealing with SMEs, there is a fortune of variability. Every business looks different from one to the next. Different in their makeup in terms of who the shareholders and directors are, and their organizational structure. They're different based on the industry they're in. They're different based on the maturity level, where their revenues are at, if they've just started or if they're much later on in their journey, how they've capitalized the business and where their working capital is coming from. There's so much more variability when you're dealing with businesses. And so for that reason, coming up with a single credit model that you can automate away and make decisions on every single business and treat them all in exactly the same way is extremely difficult. We've brought a lot of innovation into that world, but it's something that we continue to invest in and will continue investing in for a long time. But that's part of the reason why SMEs often get overlooked or underserved, because you've got so much variability, and that means that there's a lot more effort required in understanding them and working out what the right type of funding is for them, how much funding, etc., etc. So it's much more difficult, and so for that reason, Bridgement ultimately exists. It's to solve that problem.
Amazing. And one of the keywords, I suppose, in lending is secured versus unsecured. And I know a lot of the stuff you guys, I must be careful what I say. I think a lot of what you guys do, you touch on unsecured. Unsecured for people watching would mean that there's no collateral against it. So they're not putting their property up. There's no GNB over stock or something like that. So do you need, in an unsecured environment, is there a surety as well, or would a surety be considered as secured?
So we typically do take surety from at least one of the directors or shareholders. We opted, at least for the initial product of Bridgement, to go the unsecured route because of the ability to automate things and offer funding, get funding into the hands of clients in a much quicker and easier way.
Yeah.
The second you start looking at any form of security or collateral, it makes the funding a bit more complicated.
Yeah.
It makes the assessment a bit more complicated. You now have to assess the value of that collateral or the security, and how easy it would be to actually go and collect on that and things like that. That is not a world that we specialize in. Not to say that we may not offer a secured type product in the future, but we don't do that right now. And the reason for that is largely to create the quickest possible, easiest way for businesses to get funding and to solve the sort of short-term working capital needs that businesses might have.
So I suppose a secured environment would allow you to grant bigger lending facilities over time.
Absolutely.
But for what they need, as short term is the values are probably where you're between 50 and 5 million.
Yeah,
so
exactly.
That space is where it's comfortable to play like this.
Yeah, absolutely. I think, on the secured side, it's easier to do bigger amounts and also for longer terms.
Okay.
So if you want to start looking at multi-year terms, it becomes a bit easier. Not to say that we won't go down that route, but at the moment we're focused on solving one problem, which is that short-term working capital. When I say short-term, I say anywhere up to 12 months. Solving that, being really, really good at that, being and staying the best non-bank provider in that space, and then looking to expand from there at a later point.
Yeah, listen, I think what you guys do is brilliant. I actually heard a presentation. We were at an event and Nagging Panda was presenting, and so were you guys. It's the first time I'd heard the story. Was somebody called with an emergency and applied because they had I think they had to pay their PAYE or whatever it was, and there was a story that they needed 50,000 rand in a hurry.
Yeah.
And you guys actually made the extra effort to help them get through, got them the loan, and actually managed to save them the penalties and whatever it is they would have faced.
Yeah, 100%. We actually see that use case a lot, amongst many others. But one of those use cases is to sometimes businesses might not have necessarily managed cash flow properly, and they have a deadline to make a certain tax payment. If you meet that if you miss that deadline, you get hit with a big penalty, and then your interest, and it's an immediate penalty plus interest, etc. And so what we've seen a lot of some of our customers using our facilities for is to actually make those payments, and oftentimes it's just for a few days because actually the cash is coming in a few days or a week or 2 weeks or whatever it is, but taking the funding from us and the cost that they would incur from us, the cost of funding, is way cheaper than the immediate penalty that they would have received from SARS. So it's just an interesting thing that I never thought about when I launched the business. But it's just something that we've seen happen quite a few times. Actually,
I would imagine
with a couple of customers. Yeah.
Okay, interesting. And then I got a question for you. I had a specific question that's just gone off the top of my head right now. I'll circle back. But I want to ask you your thoughts on businesses in a surviving position and businesses in a thriving position. So when a business comes to you and they're in a surviving position versus a thriving position, what does that look like? And my follow-up, if you want to answer in one, is would you deal with them in both positions?
Yeah. So I think I don't know what the exact stat is. In terms of our customer base, but my good estimate would probably be around like a 70-30 split, where 70% of our client base are in a growth sort of position, and the remainder being more in the trying to manage cash flow type of position. And I think it's quite a misunderstood industry, ours. In fact, even yesterday I was on the phone with a client, and he said he's a new client. He hasn't used our facility yet. He had a couple of questions, and he said, I'm not like your usual customer. My business actually doesn't need funding. We're growing. We like doing really well. We're not in trouble. But sometimes there are fluctuations in the currencies, and I need to take advantage of that and order more stock while the currency is strong.
Yeah.
And I'd like to use your funding in those situations. So I said to him, that's super interesting, but let me just correct you. You're actually like the majority of our clients. So there definitely is a bit of a stigma attached to funding in general. And I think that largely comes from the consumer world. So in the consumer world, a lot of the time, majority of the time, consumers are taking debt for consumption.
Yes.
And unfortunately, a lot of the time, that is to live beyond their means. They're using that debt for things that they don't necessarily need. And unfortunately, and very sadly, in South Africa, we've got a history of many consumers really getting into a lot of trouble with debt and getting into debt spirals. And there's a whole host of unfortunate things that go with that. And ultimately, every business owner is a consumer in their own right. So they may have had those experiences, or may have seen family or relatives, friends having those experiences. And so there's a big stigma attached to debt financing in general.
This is, I suppose, where we were talking about this before, is the good debt versus bad debt.
Yeah, absolutely.
Very much in the Robert Kiyosaki rich dad, poor dad space.
Yeah, absolutely. So one of the nice things about being in the SME funding world, at least that I enjoy, is that when a business comes to us and takes funding, it's not for consumption like it is in the consumer world. It's for production. It's to produce more revenue.
Yes.
And so that, like,
are you able to vet that?
Yeah, absolutely, okay. Absolutely. So that key distinction makes a world of difference in terms of what our funding is being used for,
yes.
And the nature or the situation of the businesses that are coming to us. Of course, there are so many different forms of funding, both on the equity side and on the debt side. There are pros and cons to each. If you want to raise equity, that's going to come with dilution. It's going to come with other shareholders and
sure.
having to manage those relationships, and maybe a board of directors and a whole host of complexities. And then obviously on the debt side, interest is going to be charged. It has to be repaid over typically a shorter term, but it helps you avoid dilution and et cetera. And what typically makes the most sense for most businesses is a bit of a hybrid of the two. Of course, it depends. I mean, there's such a broad spectrum, and many businesses can grow into huge businesses without ever touching debt, or without ever touching equity. But there are so many different combinations, and ultimately, we when we get questions from people and they think that like debt is such a bad thing, we try and explain the concept of leverage, and using if the debt that you're using can enable you to grow your business and grow revenue, and your margins support the cost of that debt that you've taken on, then it's a no-brainer. You should be taking on as much as possible, getting as much leverage as possible. But of course, that's not always the case, and you need to always make sure that your business can support those repayments. It can cover the cost of finance, that your margins are healthy enough to cover those costs. And
that's probably actually where the traditional guys struggle to service the SME, is figuring out the serviceability and, like you said, the variability of the makeup of the SME.
Yeah, absolutely. And it's so difficult because every SME is so different. The industry that they're in, and how they price, and how what their cost structures look like in their business. Sure. It's so difficult. And then when you consider that difficulty and the administrative burden that it would create for the financier to actually assess it relative to the size of the funding, like if you want to do a small, say 100K type facility to a business, your return on that, and that's one of the many reasons why SMEs tend to get so overlooked and underserved by the banks.
And do you think that just in terms of the size of the market, if you grew Bridgement 10 times, is there still business to be done?
Yeah, absolutely. So, I mean, we've if you look at the number of SMEs in South Africa, the estimates are quite wildly. It depends on your definition of SME. It depends if you're including informal or formal, informal as well. If you're including informal businesses, there's a lot less data, much more difficult to tell. But I've heard estimates of over 2 million businesses when you include informal. But if you look at actual registered companies, that typically you're talking in the 700 to 800,000 range.
I was going to say that number's shrink quite a bit.
Exactly.
Yeah.
So when you're talking formal registered companies, you're looking more like 700 to 800,000. And even within that, if you drill down a bit deeper, a lot of those are not operating entities.
Yeah.
A lot of them aren't even registered,
Yeah.
for VAT, etc.
Yeah.
So that number starts getting a lot smaller, probably sub 400,000.
Yes, that's where I would have it as well.
Yeah. But that being said, in my mind, we've only just touched the sort of tip of the iceberg.
Okay.
And I think we could grow 10 to 50 times quite easily just in South African market, just with the same product.
Okay.
And that's excluding expanding geographically or expanding our product offering.
Okay.
So yeah, absolutely.
Amazing, interesting. And then I remembered my question. In terms of stock, so like you said, you'll help businesses grow by helping them to buy stock or to grow or whatever it is that they're doing. How do you guys get your stock? I was saying your stock is money.
Yeah.
So at some point, you've got to be getting money from somewhere to be able to send it out.
Yeah, absolutely. So, I mean, previously, a few minutes ago, I was talking about the businesses running and using a blend of equity and debt, and we do that ourselves.
Okay.
So we have a portion of equity in the business, and that came from an initial investor in the business.
Okay.
We have, and then next to that, we have a whole bunch of debt, so debt facilities.
So you're a great example of good debt.
Yeah, absolutely.
So you guys are actually, you're doing what you say.
Yeah, absolutely, literally. And so that comes from institutional funders.
Okay.
In the early days, it came mostly from asset managers, insurance companies. Given the track record and the growth that we've had since then, we now have much larger facilities that come from the major banks in South Africa.
Okay.
So yeah, that we essentially use a blend of those various funding sources to offer funding to our clients. In a way, you could think of us as a wholesaler.
Yes.
We're going to institutional funders and we're saying, give us very large facilities. We've got the tech and the platform to distribute that in lots of small amounts to lots of small and medium-sized businesses in the range, amounts in the range of, as you said, 20,000 Rand up to 5 million Rand.
Yes.
And we can operate that at scale because of the tech that we've built and the platform and the ability to assess them and grant credit in a very efficient manner. So essentially our stock is, as you said, it's funding, it's cash.
Yeah, it's cash.
And we're just a wholesaler of that. But of course, these institutional funders that we talk to would never be able to go and offer a 50,000 Rand, not even a million Rand or a 5 million Rand facility to an SME.
Yeah.
And so, that's, part of the reason why we exist.
I love it. I really do. I'm such a big fan of this business. It's brilliant. I love hearing about it. Okay. And then I want to bring it to a little bit of a full circle. And I ask all of my guests this question, but mostly they sit on the other side as opposed to on the tech side. My question is, what can tech do better? The answer is often to the human element from the guys on the other side. It's not, you're the first tech guest that I've had who could answer. So what do you think it is that tech can offer better to the market? One focus on the cloud accounting space, so guys using Xero, and then just the general, what can tech do better?
Yeah. I think that tech, at least from my perspective and in our world, tech enables a credit provider like ourselves to better manage credit risk, to better assess businesses, and also to better manage fraud risk, which is obviously always a concern. And that translates into being able to offer more funding to more businesses at better pricing. So I would say that that's probably the number one benefit of tech in our world. If I had to specifically, maybe I should add a second point to that. The second point is offering a much better experience.
Yes.
So businesses are, and not only businesses, consumers as well, but we're all so used to having really bad experiences when dealing with various institutions, not only banks, insurance and whatever it is. And I think tech enables a much better, more seamless experience, a simpler experience and a faster or quicker experience, which is something that's really important, especially to business owners that tend to be extremely time poor. So I think those are probably the two major ones. In terms of in the Xero world, I think the tech enables the seamless sharing of financial data. So it removes the need for a business to have to upload bank statements, PDF bank statements, or upload management accounts and things like that. A Xero customer can come to our website, click a button, connect their Xero account in the same way they connect to any other Xero app, Nagging Panda or any others. We get their financial data and can grant them funding. There's no need for uploading of documents and collecting lots of bank statements or Manacs or whatever it is. We can leverage all of that Xero data. So in the Xero world, I would say that tech similarly enables the offering of a much better experience, quicker, simpler experience, as well as better credit management and assessment, better fraud risk management and prevention, which translates into a better finance or funding product for SMEs at better pricing. And I would say that's probably it.
Cool answer. And again, that's a great one because that's from the tech perspective, and I'm fully there. I love that. So last question for you, and just to wrap it up entirely, on your thoughts on a business shifting from surviving to thriving, because you've seen plenty of them, you're working with them often. What any advice or something for somebody in that survival position, how he might get across to that thriving position? Maybe you could relate to them, say how you felt when you were doing it. Just some advice for the viewer in that position.
Yeah, it's a good question. I think for a business surviving, in my mind, and I'm obviously very skewed in what I focus on, and I'm sure there are many other good answers to this question, but ultimately managing cash flow is critical in a business, and managing cash flow, solving for that problem, there are many ways to do it. Funding obviously is one of those ways, but it's not always the answer, and sometimes there are better, quicker, even cheaper options available. Sometimes several of those options make sense. For business managing cash flow, we see it so often where they're really being squeezed on both sides, both by their suppliers as well as by their customers. Obviously depends on the industry they're in and the nature of the payment terms that are typically offered.
But it's ringing bells for me as well.
But you see it all the time where a business is being squeezed by their suppliers. The suppliers are not offering them trade credit, so they're having to pay upfront or put up a deposit or whatever it is. And then there's obviously a delay for them to receive that inventory or stock. Again, obviously depends on the industry we're talking about. And then they sell their product on to their customers.
Probably on terms.
And they might offer credit terms to those customers, and then they get paid 30, 60, 90 days later. Obviously, again, depends on the industry, depends on the customer, etc. But we see a lot of difficulties in managing cash flow arise just from those two pieces of the puzzle. And so I think there are a lot of strategies that businesses can take, especially if they're in that sort of survive mode, in terms of negotiating with suppliers and getting better payment terms from their suppliers. And then also on the customer side, ensuring that their customers get paid quicker. So maybe not offering as much trade credit or requiring deposits or using a tool like Nagging Panda to get paid quicker. So I think that's probably one of the big pieces. And of course, funding is another tool, in a business owner's tool set to use to manage cash flow. But it's not necessarily the only tool, and I would always say that you need to consider all options, and typically you want to tackle all of them, because they'll probably have the biggest impact.
Cool. Well, guys, thanks, Dan. Thanks so much for being with us, first of all, but to everybody watching, it's another episode of Thrive Talk with an expert, truly brilliant in his field. I hope you enjoyed that conversation as much as I did. As always, talking to these guys is just so inspiring. And as always, I hope you thrive in your business.